This is the usual figure for the income statement, as we said before. And the income statement consists of the main items are revenues less cost of goods sold. It will give me contribution margin. Deducting or less the operating costs, it will give me operating income. Here we will calculate revenues by, as we said in chapter 3, units sold multiplied by selling price. It will give me sales revenue. Less. Under variable costing method, I'll calculate only the variable manufacturing costs. So we will deduct or write the variable costing or variable cost of goods sold only. And we said in chapter 2 that cost of goods sold statement, how to calculate the cost of goods sold: beginning inventory plus manufacturing costs during the year. It will give me cost of goods available for sale deducting منها ending inventory. It will give me the cost of goods sold. So we will calculate only the variable cost of goods sold because we prepare the income statement under the variable costing method. So variable cost of goods sold will consist of beginning inventory, add variable manufacturing cost during the year. It will give me the result will be variable cost of goods available for sale. Deduct ending inventory. It will give me variable cost of goods sold. This is the variable cost of goods sold type. Let's go to the first item, which is beginning inventory. How we calculate the beginning inventory? We will multiply the beginning inventory units by the variable cost per unit, and we will get the beginning inventory cost. And the variable manufacturing cost during the year, we will multiply the unit produced during the year multiplied by the variable cost per unit. طب how we calculate the ending inventory cost? By multiplying the ending inventory unit by multiplying the ending inventory units by the variable cost per unit. This is the variable cost of goods sold, and plus the variable marketing cost, deducting the variable cost of goods sold and the variable marketing costs from the sales revenue. You will obtain the contribution margin. How we calculate the variable marketing costs? By multiplying units sold by the variable marketing cost per unit. So the inventoriable costs under the variable costing method are the variable cost of goods sold and the variable marketing costs. These are the inventoriable costs. We get here the contribution margin. We will less or deduct all fixed costs, fixed manufacturing costs and fixed marketing costs. We will deduct them from the contribution margin to obtain the operating income. From this figure, we can say that under the variable costing method, the period costs are the fixed cost, all the fixed cost, fixed manufacturing costs and fixed marketing costs. Or we can say that under variable costing method, we can say that inventoriable costs are all variable costs, variable cost of goods sold and variable marketing cost. The next figure is the income statement also, but under the absorption method. Under the absorption method, as we said before, the absorption method contains all costs, or it includes all costs, fixed and variable. So here the income statement will be as follows: revenues minus total cost of goods sold, not variable. Here we will calculate all costs, fixed and variable, minus total cost of goods sold. And we said before how we calculate cost of goods sold: beginning inventory plus variable manufacturing costs plus allocated fixed manufacturing costs. It will give me cost of goods available for sale deduct ending inventory, we will get total cost of goods sold, and we will deduct the cost of goods sold from the revenues. We will obtain the gross margin or contribution margin minus variable marketing costs and the fixed marketing costs. We will obtain the operating income. So we can say that under the absorption costing method, the period costs are variable marketing costs and fixed marketing costs. Okay, and we can say also under absorption method, the inventoriable costs are variable manufacturing costs, allocated fixed manufacturing costs, and or we can say that the absorption, the inventoriable costs is the total cost of goods sold. Here the variable manufacturing costs and all allocated fixed manufacturing costs. Here he divides the manufacturing costs to two sides or two items in order to note the difference between the variable method and the absorption method. I hope you understand this clearly. Let's go to some multiple choice questions, and we will explain them together. Which of the following is true of absorption costing? Which of the following is true of absorption costing? It expense marketing costs as a cost of goods sold? No. It creates direct manufacturing cost as a period cost? No. Under absorption costs, it includes fixed manufacturing overhead as a inventoriable cost, because we under absorption costs, it includes fixed manufacturing as inventoriable costs. Number 2, which of the following is true of a variable cost? True variable under variable method. It creates direct manufacturing costs as a product or inventoriable cost. Product cost or inventoriable, the same meaning. Number 3, in what method fixed manufacturing costs are included as inventoriable? Fixed manufacturing created as inventoriable under the absorption costing method. In number 4, in which method it includes fixed overhead, fixed manufacturing overhead as inventoriable? The same question, but in another meaning, under absorption costing method. Number 5, is the manufacturing incorporation makes a product with the following cost per unit: direct material, direct labor. Direct material 180, direct labor $20, manufacturing overhead variable $30, and manufacturing overhead fixed $130. Marketing costs equal $75. What would be the inventoriable cost per unit under variable costing, and what would be under absorption costing? First, we will calculate the under the inventoriable cost under variable costing. Under variable costing, we will include, or we will take only the variable costs like direct material and direct labor and variable manufacturing overhead only. These are the inventoriable costs: direct material, direct labor, and manufacturing overhead variable. So we will sum the 180 plus 20 plus 30 will equal $230. This is the inventoriable cost per unit under variable costing or under variable method. Under absorption costing method, we will take all costs, all manufacturing costs will be inventoriable: direct material, direct labor, manufacturing overhead variable plus manufacturing overhead fixed. We will take all the manufacturing costs. So we will sum 180 plus 20 plus 30 plus 130. It will give me 360. So the inventoriable cost per unit under absorption method will be 360. So the answer will be number C. Number 6, Rolex produce and sell a mental clock for 100 dollar per unit. In 2017, 42,125 clocks were produced. This is the number of units produced. And 37,958 units were sold. Other information for the year includes direct material $43 per unit, direct manufacturing labor $5 per unit, variable manufacturing cost $3.5 per unit, sales commission $14.5 per part, fixed manufacturing costing $65 per unit, administrative expenses all fixed by $37.5 per unit. What is the inventorable cost per unit using variable costs? Using variable costing, the inventorable costs using variable method. As we said before, variable costing consider all variable manufacturing costs as inventorable, all variable only. Therefore, in this case, the direct material and the direct manufacturing labor and the variable manufacturing costs costs will be considered as inventorable costs. So the total inventorable costs will be direct material. We will sum direct material by $43 plus direct manufacturing labor $5 plus variable manufacturing cost $3.5. So the inventorable cost per unit under variable costing method will be $51.5. So the answer will be number P. Number 7, Alba produces and sell a mental clock for $100 per unit. In 2017, 41,000 clocks were produced and 37,000 units were sold. Other information for the year: direct material, direct manufacturing labor, variable manufacturing costs, and sales commission, fixed manufacturing costs, administrative all expenses. Under this condition, we will calculate what is the inventorable cost per unit using absorption method, using absorption costing method. Under absorption costing method, all variable manufacturing costs and all fixed manufacturing costs are inventorable. All variable manufacturing and all fixed manufacturing costs are inventorable. Therefore, in this case, we will calculate the inventorable cost by adding direct material cost plus direct manufacturing labor cost plus variable manufacturing cost plus fixed manufacturing cost. All these costs are inventorable under the absorption method. So we will sum the direct material by $42 plus direct labor by $7 plus variable manufacturing cost by $4 and the fixed manufacturing cost by $64 per unit. So the result will be $117 per unit.